This question tests your understanding of cost allocation in responsibility accounting, particularly the reasons why firms allocate corporate and support service costs to divisions and profit centers. The question asks for the statement that is not a valid reason for allocating these costs. In decentralized organizations, headquarters and service departments, such as HR, IT, legal, and accounting, incur costs that support multiple divisions. Allocating these costs to divisions serves several purposes. It reminds division managers that their operations must generate sufficient profits to cover not only direct costs, but also a fair share of corporate support costs. IT improves accountability by providing a more complete measure of divisional profitability. IT encourages managers to evaluate whether internal services are being provided efficiently and whether excessive support costs should be challenged. However, cost allocation is not intended to create competition among divisions. Its objective is to promote goal congruence, accountability, and cost awareness, not rivalry between organizational units. Likewise, managers should not pressure central service departments simply because costs have been allocated to them if those costs are largely uncontrollable. The key concept is that allocated costs should improve decision-making and performance evaluation, not distort managerial behavior or create dysfunctional incentives. Remind profit center managers that earnings must be adequate to cover some share of the indirect costs. Incorrect. This is a recognized purpose of allocating corporate support costs. B. Stimulate profit center managers to put pressure on central managers to control service costs. Correct. Cost allocation is not primarily intended to encourage profit center managers to pressure central service managers. Many corporate support costs are not directly controllable by profit center managers, so this is not an appropriate objective of allocation. C. Create competition between divisions and departments and their managers. Incorrect. While competition itself is not the purpose of allocation, this choice is less directly related to the accounting objective than B. Standard management accounting texts identify B as the exception because allocations are not designed to shift responsibility for central service cost control to profit center managers. D. Fix accountability and evaluate profit centers. Incorrect. Cost allocation is widely used to improve responsibility accounting and evaluate divisional performance. Correct answer, B. Stimulate profit center managers to put pressure on central managers to control service costs. The primary objectives of allocating corporate support costs are cost awareness, accountability, and performance evaluation, not to encourage profit center managers to pressure central service departments regarding costs that they often cannot directly control. This question tests your understanding of service department cost allocation and the use of budgeted rates versus actual rates in responsibility accounting. An effective allocation system should achieve two objectives simultaneously. Prevent production departments from underestimating their expected use of service department resources during the budgeting process. Encourage service departments to control their own costs efficiently, rather than passing inefficiencies to user departments. The best way to achieve these objectives is to separate variable costs and fixed costs. Variable service costs should be allocated using budgeted rates and the standard quantity of services allowed for the actual output achieved, so production departments bear the cost of the services they actually require while service departments remain accountable for spending efficiency. Fixed service costs should be allocated using budgeted rates based on available capacity, preventing production departments from manipulating budgeted demand and ensuring that service departments remain responsible for managing unused capacity. This dual-rate approach promotes goal congruence, fair performance evaluation, and efficient resource planning. A. The use of actual rates and actual hours for both fixed and variable costs. Incorrect. Actual rates pass service department inefficiencies to production departments and provide poor cost control incentives. B. Budgeted rates and standard hours allowed for output attained for variable costs and budgeted rates and capacity available for fixed costs. Correct. This approach encourages efficient use of services by production departments while making service departments accountable for controlling their own costs and capacity utilization. C. The use of rates and quantities based on long-term historical averages for both variable and fixed costs. Incorrect. Historical averages may not reflect current operating conditions and do not provide appropriate behavioral incentives. D. The use of a budgeted lump sum amount based on estimates provided by the production departments for both variable and fixed costs. Incorrect. Production departments may intentionally underestimate service usage to reduce allocated costs, leading to inaccurate budgets and poor planning. Correct answer. B. Budgeted rates and standard hours allowed for output attained for variable costs and budgeted rates and capacity available for fixed costs. This dual-rate allocation approach promotes accurate budgeting, discourages underestimation of service usage, and motivates service departments to operate efficiently, making it the preferred method for responsibility accounting and service department cost allocation. This question tests your understanding of transfer pricing, a key concept in responsibility accounting and decentralized organizations. A transfer price is the price charged when one division or responsibility center transfers goods or services to another division within the same company. Transfer pricing is used to measure divisional performance, motivate managers, and support decision-making. The phrase, "incorrect description," is the most important clue in the question. Students must identify the statement that does not describe transfer pricing. Transfer prices apply only to internal transactions between departments, divisions, or profit centers of the same organization. They do not apply to sales made to outside customers. Companies commonly determine transfer prices using one of several methods. Market-based prices, when a competitive external market exists. Cost-based prices, such as variable cost, full cost, or cost plus markup, when no external market exists. Negotiated prices, agreed upon by the buying and selling divisions. The objective of transfer pricing is to encourage goal congruence, provide fair performance evaluation, and ensure that divisional decisions support the overall profitability of the company. It measures the value of goods or services furnished by a profit center to other responsibility centers within a company. Incorrect. This correctly describes the purpose of transfer pricing, which applies to internal transfers. B. If a market price exists, this price may be used as a transfer price. Incorrect. A market-based transfer price is widely regarded as the preferred method because it reflects an arm's-length transaction. C. It measures exchanges between a company and external customers. Correct. This statement is incorrect because transfer pricing applies only to internal exchanges between divisions within the same company, not to transactions with external customers. D. If no market price exists, the transfer price may be based on cost. Incorrect. Cost-based transfer prices are commonly used when no competitive market price is available. Correct answer. C. It measures exchanges between a company and external customers. Transfer pricing is an internal accounting mechanism used to value transfers of goods and services between responsibility centers within the same organization. Sales to external customers are normal market transactions, not transfer pricing transactions.